This is the DoughRoller Money Podcast, episode number 187. My name is Rob Berger. I'm the founder of DoughRoller.net and the host of this podcast. Today we're going to be talking about how to go about generating income from your investments during retirement. I have on the show today Dr. Pfau, who has written extensively on this topic. I think you're going to really enjoy his interview. We're also going to talk about the cost of higher education and how some of what seemed like about 1,000 candidates for president, more than I can remember in my lifetime during the primaries, how they want to tackle that important issue and how we might think about it ourselves as we evaluate what we think is best. And I even have a tool today that we're going to talk about for those that are interested in possibly using solar energy to heat and cool their home. I've got a tool for you, an online tool we're going to talk about that will help you estimate the cost and savings of a solar energy system.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, hope you're having a great day. So first up today, we have higher education. So with the presidential election sort of cycle now pretty much underway, with the first Republican debate having been completed, and you've got Hillary Clinton and I guess Bernie Sanders on the Democratic side, and on the Republican side you've got, I don't know how many people it is now, 16. I'm not even sure, I've lost count. We start to hear what their views are, their proposals, how they would lead our country, what's important to them, what they think is important to us in the future of our country. And one of the issues that's come up is higher education. And I wanted to just describe this issue, and then I want to kind of hear from you as to what your thoughts are on it. It kind of hit the news. All the candidates have their views on higher education and what we should do about the cost of it. But I think it really became more prominent in the news cycle here recently because Hillary Clinton came out with a program that would cost $350 billion, that's with a B, $350 billion over 10 years. And I don't have all the specifics, for example, how exactly that money would be raised, but it would certainly be, from what I understand, a tax on, I suspect, higher earning individuals. And it would help with the cost of college and the cost of those struggling with debt. That was her a recent proposal. And as I looked at that and I started to look, okay, well, what are the other candidates? How do they want to deal with this? I guess sticking with the Democrats to begin with, Bernie Sanders' proposal is that a public college education should be free. Or we call it free. Obviously, nothing is free. So again, I don't know the specifics of his plan, but in some way there would be taxes levied. I don't know, again, if it would be on higher income folks or not. And then that would offset the cost of a public college degree. That's his approach. On the Republican side, of course, there's so many Republican candidates. They all have slightly different views on how to deal with this issue. But from what I have read, none of them propose, that I've seen, raising taxes to generate income to then fund college education. They sort of take the other side of the equation and say, okay, how can we cut costs? That their view is, that costs have gotten completely out of hand. They've gone up by far more than the rate of inflation. And I think some view the amount of government aid involved in higher education as part of that problem. By the way, there are studies on that, and they kind of go both ways. The Fed has studied it. Others have studied it, whether the government aid increases tuition. Kind of makes sense to me that it would, but actually the studies I've read kind of show it going both ways. But the Republican candidates tend to want to tackle costs in some way to bring down the cost of education, and in some cases even reform higher education as we know it. Although again, it's always a question of specifics. One thing I'll say is that, particularly for those that are interested in becoming a programmer or web developer, I think there's been a number of startup organizations where you can get a really good education in coding in about 6 months in a code boot camp, and there's several around the country. They tend to be in places like, Colorado, Austin, Texas, New York City, San Francisco. So they're not everywhere. But folks are finishing out those 6-month programs and landing high 5-figure and low 6-figure jobs. So it's kind of interesting to see that as sort of a totally different approach to what I would call higher education. And I think that's fantastic. But back to our presidential candidates, again, they tend to be split between the Democrats wanting to raise taxes to generate income to offset the cost of education, versus the Republicans want to in some way tackle the cost of education to bring down the cost of higher education and perhaps even change the way we think of higher education. Again, I think on both sides, there's not a whole lot of detail at this point, but that's pretty normal. You wouldn't expect a whole lot of detail at this point. So I'm curious what you think of that. First of all, is there a problem? Is the cost of higher education even a problem right now? I think a lot of people think it is. What do you think? And if it is, how should we deal with it? So shoot me an email, dr@DoughRoller.net. Let me know what you think. You can also leave a voicemail, and I'd be happy to play your views on an upcoming show. Just go to DoughRoller.net/voicemail. That will redirect you to a page where you can leave a voicemail. And I would love to hear your thoughts and love to share them with everybody. By the way, I do want to bring these issues up in future podcasts as we work through, the primaries and eventually the general election. Again, issues that, a lot of issues are at stake in any presidential election. For this podcast, I'm focused on the ones that affect our pocketbooks, right? Money, investing, taxes, and education. It's important. Whether we like it or not, what our politicians do in Washington, what they do in our state capitals across this country, what they do in our local communities, regardless of, your political views, they're going to have a big impact one way or another, for better or worse, on our money, our investments, our taxes, unemployment, business, the future, for the economic future of our country. And I think it's important to discuss those issues, hopefully in a rational and intelligent and thoughtful way. At least that's my goal. You'll let me know if I've accomplished that or not. So let me know what you think on the education plans, and hopefully we'll get even more details down the road as to what how they would approach this issue if they were elected president. Okay, so on to the interview today with Dr. Pfau. He's written a lot about retirement, about investing while you're in retirement or nearing retirement, and in generating income. And he's done a lot of work with Kitces, and I hope I'm pronouncing his name right, but I've mentioned him in the past. And he's got a great website, Michael Kitces, KITCES.com. He's got a great blog. He really writes for investment advisors. That's his audience. But if you go to his website, you follow his blog, I find that he has a lot of great information that helps investors, whether you're focused on asset allocation, retirement, whatever. It's a great resource. So anyway, Dr. Pfau has done a lot of work with him, or some work that I've noticed in the past. And so I wanted to get him on the show, and we kind of talk about, we really talk about a lot in today's interview, but obviously all kind of related to investing and retirement. I think you'll really enjoy the interview. So without further ado, Dr. Pfau, welcome to the show.
Thanks. It's a pleasure to be here.
Well, I'm thrilled that you could take a few minutes to talk with us. I've read your work, and of course, your work is cited pretty much all over the internet. So I've kind of followed your work for quite some time, and so really honored to have you on the show. Why don't you just to start off, tell folks about who you are and what you do?
Mm-hmm. Sure. Yeah. Well, I have the website retirementresearcher.com. I'm actively involved in research about retirement income planning, which is still a relatively new field. And actually my job title is Professor of Retirement Income at the American College. It's a pretty unique job title in the world. As far as I know, no one else has the same job title, but the American College has fun with trying to get a little bit more variety with professors of something at the school. And primarily now the American College has the RICP designation, Retirement Income Certified Professionals, which is growing very rapidly, and really just focusing on this new field of retirement income planning and how it's different from traditional saving and accumulating wealth.
How did you get into this area of research?
I've always had some connection in that. Going back to my days as a graduate student, my dissertation was about Social Security reform, and specifically President Bush, the second Bush, had the proposal to carve out part of Social Security to create personal retirement accounts, which is basically then just what happens when you're saving and investing and trying to manage your own retirement. So that was really the genesis of it in terms of the programming I did to simulate how that reform proposal would work. Ultimately would tie into general retirement income planning and simulating retirement outcomes for individuals.
What did you think of his proposal?
At the time, I was more mixed that it could potentially work, but not necessarily as well as usually advocates of those sorts of proposals will say, well, the stock market earns 7% after inflation, so it's ridiculous not to just put all your money in the stock market. And I had a more nuanced approach to that. And in hindsight, I realized increasingly as well that for most Americans, it really is helpful to have a defined benefit pension. And Social Security has inflation protection, longevity protection, market protection. So it's really very important, and to start carving up part of it to create personal accounts and reducing the amount of the traditional Social Security benefit, I think that would be problematic for a lot of Americans.
Right. Well, let me kind of move to a slightly different topic, and that is, and I get this question a lot from those that listen to this podcast, and that is, as they're nearing retirement, how should they be investing their money? And I know, in fact, you had a recent article, I think, on your blog about glide paths. And, there's some talk about inverse glide paths and all that. Should you go from a lot of equities to fewer equities as you get closer to retirement and then into retirement, or should you do something else? What's your view, and what's the available sort of research out there on how folks should invest their retirement as they're getting near to, whatever the age is for them, 65, to retire?
So the way I really think about this is to follow a U-shaped lifetime stock allocation glide path. That I'm comfortable with the notion behind target date funds and things. In the pre-retirement period, when people are young, they tend to have a higher stock allocation, and they reduce that stock allocation as they get near the retirement date. And how far they reduce it really depends on a case-by-case basis of how comfortable someone is with the market volatility and how much capacity they have to take risk and so forth. But then the question is, what do you do post-retirement? And traditional target date funds are generally somehow linked to either holding the steady stock allocation or continuing to decrease the stock allocation post-retirement. I've done some research with Michael Kitces where we talk about actually as a risk management strategy to gradually increase the stock allocation post-retirement. But that means starting off retirement with a lower stock allocation than you might otherwise have in response to a lot of the research. Well, we can maybe talk later as well. There's really two completely different schools of thought about how to plan for retirement. The one school of thought about using an investment portfolio and spending from the portfolio recommends generally that retirees have 50 to 75% stocks in retirement. And sort of as a response to that I don't think everyone's comfortable with that high of stock allocation. And they don't necessarily need to have that high of stock allocation throughout retirement.
Right.
As the basic starting point of this idea of a U-shaped.
Well, let me make sure we understand the U-shape. So this is where, if you're, say, 25, you might have significantly more stock. Well, again, It's going to vary from person to person, but let's just say someone has 90% stocks, 10% bonds. On the U-shape approach, as you near retirement, that's going to change. It's going to shift to something where the bonds are far more significant than just 10%. Maybe it's 50-50. Maybe you even have more bonds than stocks when you enter retirement. But then as you enter retirement and you start to age and live in retirement, the other side of the U kicks in, and you actually, in retirement, start increasing your exposure to equities.
Right. Right, that you have your lowest stock allocation in your lifetime near the retirement date.
Yeah, see, that's something that I think a lot of people just have never heard before. That in retirement you're actually going to make your portfolio more volatile. Why would that be a good thing?
It's a risk management technique, and it's actually when you're thinking from a household balance sheet perspective of tallying up all the assets and looking at things like Social Security benefits as an asset, it's something that's naturally going to happen for most people anyway, that their stock allocation as a percentage of all their household assets will tend to increase as they age. But I view it more, it's a risk management strategy that when you look at what are the worst case scenarios that generate poor retirement outcomes, it's having poor market returns early in your retirement. If you have good market returns early on and poor market returns later on, you're generally going to have a successful retirement anyway because you're already going to be on a trajectory towards success. But if you get the poor market returns early on, well, the really catastrophic scenario is you have a 30-year retirement with poor market returns the whole way through, and there's nothing you can really do in that case.
Right.
But the more realistic type of worst-case scenario is poor market returns early on, and then markets do better later on. And that's exactly the kind of scenario that a rising equity glide path will help you out with compared to just having a high stock allocation the whole time.
Sure. So with a low stock allocation at retirement, if there's a bad market, it's not going to hurt you as much. And then as you age and you hit 70, 75, 80, you can increase your equities because yes, even then you could have a bad market, but your investing horizon now is much shorter because you're older, and so
right.
Yeah. So what would be sort of a range of stock to bond allocations that the U-shaped approach would suggest at the point of retirement?
It does really vary by person, but as a baseline case study that we looked at in more depth because we thought it might be pretty realistic for a lot of people is starting retirement at around 30% stocks and increasing over time to 60% stocks.
Okay. And I take it you back tested this?
Right. Uh-huh.
And what was the
but again, that's not a recommendation. That's just simply we thought for a lot of people that might be a reasonable set of numbers.
Well, so I'm just trying to think this through. So I've talked to the folks at Vanguard. I've had them on the show, and we've talked about the 4% rule. One of the things they say about the U-shaped is that in addition to the glide path and the impact of bad returns early in retirement, all those things, you ought to also recognize that a lot of things change during retirement. And we talk about this 30-year period of retirement, but our spending requirements tend to change. They tend to go down over time. You know, when you're 65 and retiring, maybe you're traveling and you're whatever you like to do. You're playing golf or whatever your thing is. But when you're 85 or 90, at least most people aren't doing those sorts of things. So costs go down. And the other thing is that when you're 65, even if you retire, if you had to, you probably could go back to work, or at least if not full-time, part-time. When you're 90, maybe that's not as realistic. And so I'm curious if those sorts of considerations impact your view of the U-shaped investment approach.
Mm-hmm. Well, on the idea of your spending decreasing as you age, that would actually help this argument that you're less vulnerable at that point because you're having to withdraw less. You're less exposed to sequence of returns risk as you go through retirement. On the other issue of the reduced flexibility, I think the main argument against this is that as people age and get into their 80s and 90s, we're not saying they would necessarily ever have a higher stock allocation than the traditional investment-based retirement income strategies are advocating, but nonetheless, they might have got used to less volatility earlier on, and then you're asking them to take greater volatility later on. That might just psychologically be a problem.
Right.
Though by that point, it's really if you just have a basic spending goal you're trying to meet, you're either going to be on a trajectory to success where if you're using a conservative spending rate and you're not in a worst case scenario, your wealth is going to continue to grow. the percentage of the portfolio you have to withdraw to meet your spending goal is going to decrease. Your time horizon is getting shorter. You really are on a good path to having a successful retirement. And so it's not, at that point, not going to matter so much what you do. But certainly there are psychological considerations for that. That's, I think, a valid argument against using, I'm not saying everyone should use a rising equity glide path. I'm just saying it works as a risk management strategy, and if people would like to consider it, then great. But if they don't, that's fine as well.
Well, whatever approach they take, whether it's the U-shape or the more traditional approach where your equities just slowly decline over time to maybe a point where they just level off. But what's your view on the 4% withdrawal rule? Is that still a valid rule? Is that a good approach to retirement spending?
Mm-hmm. So the 4% rule has a lot of simplifying assumptions built into it, because when it was developed in the 1990s, it was to bring expectations down. One of them is that people always just adjust their spending for inflation. And that causes unique problems for trying to actually use that as a strategy, because that really amplifies this sequence risk that if you get a poor market return early on, and you don't cut your spending, that really hurts your chances for retirement success. So that, with that caveat, that real people need to adjust their spending. But if they're not, if they're simply going to adjust spending every year for inflation, then I do think 4% is too high in the current environment where interest rates are so low. And I think people really don't understand. They think, well, the 4% rule is based on the worst case scenario in U.S. history. But we've got 10-year Treasury yields right around 2%. They're a little bit above 2% now, but they were below 2% earlier in the year. The only other time in U.S. history that happened was for a few months around the turn of 1941. And though the 4% rule did work in that one case, that's only one example. If you flip a coin once and you get heads, it doesn't mean you're safely going to get heads every time you flip the coin in the future. It's just one time, one experience of a retirement beginning in such a low interest rate environment. And what that means is in most of the U.S. history, a basic total returns investment portfolio was generating at least 4% in terms of interest and dividends. That's not the case today. A retiree starting today, trying to use the 4% withdrawal rate and investing with a total market type investment strategy, they're going to have to dip into principal, and that's amplifying the sequence risk. So I don't think 4% is the safe withdrawal rate in this environment. I think if you really want to have inflation-adjusted spending, 3% is a much more reasonable number than 4% when interest rates are so low.
And that, of course, would increase significantly the amount of money you would need to have saved to generate the same amount of income.
Mm-hmm.
Right.
Right. So to the extent that's not practical, it's really then a matter of being flexible and being able to adjust spending if we do get a market decline early in one's retirement.
Right. So if you have flexibility in how much you take out each year, you might be able to start at 4%, recognizing that if the market is down in a given year, you either will have to forego any inflation adjustment or possibly, I suppose, even take out a little less than you took out the year before.
Right.
Is there any sort of research around the mechanics of that, the sort of floor and ceiling, if you will, if you want to take that sort of, I guess it's a dynamic approach to withdrawals?
Yeah, there is. I wrote an article just in March making sense of variable spending strategies where I tried to compare 10 different, there's a ton of these types of strategies that you can find on the internet. And I tried to compare them all on a more equal footing, just using the same underlying market assumptions and the same kind of calibration for how much risk there was on the downside. And then Tara Siegel-Bernard wrote about this in the New York Times on May 9th. She had a really great column about it that became the most emailed article in the past 30 days at the New York Times. So it was a hot topic.
I read that article. It was very good.
Yeah, and it summarized some of the results from my research article.
Okay, well, I'll track those down.
There's a lot of different strategies.
Yeah. I will track those down and make sure folks listening have access to those in the show notes. I'm curious, are you familiar with, in terms of retirement spending and investing, the bucket approach. You have maybe 3 buckets of investments, one for, say, the first couple of years, and maybe a second bucket for, say, years 3 through 10, and then a third bucket for things for spending that will occur beyond 10 years. Are you familiar with that approach?
Yes.
So what are your thoughts on that, or what does the research say about retirees taking that approach to investing their money?
Well, I talk about 2 schools of thought for retirement income, the one that relies only on investments, and then the other extreme is essential versus discretionary, of having some sort of guaranteed floor for essential spending needs and then taking more risk for the discretionary expenses. And I view that bucket approach as a hybrid that combines elements of both of these schools of thought, that having holding fixed income to maturity to cover upcoming expenses reduces the market risk for upcoming spending. That helps to alleviate the sequence of returns risk. And so it can be a matter of, well, if a retiree uses a 60-40 portfolio of stocks and bonds, the bonds are meant to reduce portfolio volatility. But you could say, well, if I want to have 8 years of income, 8 years of bonds maturing to provide the income that I'm looking for, and it costs about 5% of my assets to cover each year, then 40% bonds means I've got an 8-year bond ladder, and the 60% stocks then goes into covering expenses for years 9 and beyond. It is based on the idea that if you leave stocks alone for long enough periods of time, they're going to grow and you'll be better off. And then having some sort of mechanism in place to move assets from the growth portfolio into the fixed income portfolio over time. And in terms of the research about whether this is truly a superior strategy, it doesn't seem to be the case. It's just a different way of thinking about the asset allocation. But in terms of people's understanding and behavior and being able to stick to a strategy, it does really seem to be the case that people can understand why their asset allocation is what it is when they're using this sort of bucketed approach, and that can help them to stay the course. And so not panic if there's a stock market decline, because they know they don't need to dip into their stocks for a few years at least. So I think it's a pretty viable strategy that it's on an equal footing with other types of investment approaches, not necessarily superior, not necessarily inferior, but nonetheless maybe superior just in terms of people being able to follow the strategy better and not because the worst thing a person can do is panic and sell their stocks after a market decline.
Yeah.
And if they're more likely to do that with a traditional asset allocation, stock and bond funds, then that's not good. So, so that would definitely lean in favor of a bucketing approach.
Yeah. What you mentioned that we're at historically low interest rates. What do you think is going to happen to stock and bonds when interest rates rise?
Well, bond prices will naturally decline if and when interest rates rise.
Right.
That's just the mathematical link that as interest rates go up, bond prices decline.
Sure.
Stocks, it depends more on the reason for the interest rate increase, whether it's being caused by inflation or being caused by the underlying real interest rate. It's a little bit harder. I don't really like forecasting too much because most of the time that you hear a forecast, it ends up being wrong anyway. But certainly there's some potential for there to be some panic and for stocks to decline if interest rates suddenly start rising rapidly.
Have you followed? I'm kind of just throwing different, topics at you, but are you familiar with the automated investment services, the robo advisors like Betterment and Wealthfront?
Uh-huh.
Do you have opinions on those types of services as it relates to investing and even investing into retirement?
Well, investing into retirement is a whole different story. I don't think they've made any progress on that regard because they're really just traditional asset wealth accumulation type saving for retirement, not post-retirement distributions. I know some of the guys at Betterment, and they're just trying to play a game of catch-up and having something for their retirement distribution, but it's not well thought out at all. Okay. In terms In terms of pre-retirement, I think what they're ultimately doing is showing that, because I tend to be a somewhat passive investor myself, that investing has been commoditized, and now it's being shown to be worth about 30 basis points, or about a 0.3% fee. So that financial advisors who are charging 1%, well, they need to provide more value than just investment management. And if they are not providing more value, they're probably going to go out of business. But if they are providing more value, well, there's a lot of great things that financial advisors can do for their clients that more than would compensate for a 1% fee. And just simply now there's like robo advisors for advisors, where they can outsource the investment management piece and pay that 30 basis points of the fees, keep the other 70 basis points, and do financial planning and building, taxes and estate planning and everything else that there is to do. And ultimately, those robo-advisors, I don't see them, they're probably going to drive some advisors out of business, but I think good financial planners will be able to compete for a long time still, because the robo-advisors are really just simplified building an asset allocation based on a few questions and trying to get a basic risk tolerance.
Yeah, I agree with that. I think investment advisors will be around for a long time. Well, for a couple of reasons, and that is some people just aren't knowledgeable enough to appreciate the significance of a 1% fee. I talk to them all the time. They come to me and before they listen to this podcast or whatever, had no idea what the impact of 1% seems like such a small amount.
Mm-hmm. But when it compounds over time.
Yeah. And so a lot of people just don't even really appreciate the significance of that. The interesting thing for me, though, will be, because you mentioned, these advisors have to provide services beyond just asset management in order to justify the fee. I'm not so sure they can do that. Certainly they can. They provide a lot of great services, and they can justify, say, an hourly fee for those services. But to justify a 1% fee, the numbers, over 20, 30, 40 years of investing, a 1% fee, the numbers just get enormous.
Mm-hmm. Yeah, the tyranny of compounding fees.
Yeah. Anyway,
but that's for and if it's a good advisor, though, with tax planning and everything else, it's possible to leave, and also just having a good asset allocation. If someone left to their own devices if they're good at all this, then okay, but they may make so many mistakes with their finances that they would be much better off paying a 1% fee, but having a better overall plan.
Sure. I noticed on your website you have something called the Retirement Income Dashboard. What is that?
So the dashboard is an attempt to summarize these two different schools of thought about retirement income planning and show, based on today's interest rates and today's annuity payout rates, which of course are linked to interest rates and everything else, what are reasonable estimates for sustainable retirement income right now it's just set up for a 65-year-old couple, but I hope to expand that. But what's a reasonable amount of retirement income to expect for a 65-year-old couple currently for somebody retiring today, and going well beyond just applying the 4% rule randomly, but really linking it to today's interest rate environment and how that impacts retirement income.
And so what's the conclusion?
The conclusion is that with interest rates so low, you should expect less than 4%. But then it's a matter of, do you want to go with an investments-only type strategy in terms of stock and bond funds, or do you want to use some sort of dedicated income, whether that be holding individual bonds to maturity or using income annuities, which provide that risk pooling and so longevity protection as well. One of the main conclusions coming out of it that people have to understand, with an investments-only strategy, you have to be extra conservative because you're planning to live a very long time and have to assume poor market returns as well. The safe spending rate is going to be less than you could get if you were to build, for example, a 30-year bond ladder, which doesn't have longevity protection, or using an income annuity. just because of that additional conservatism. It has more upside potential with investments, but the downside risk is there, and that forces greater conservatism. But and also as well, there's the flexibility piece. If you're willing to adjust your spending in response to poor market returns, you can start spending at a higher initial rate. But nonetheless, all the numbers on the dashboard are generally, depending on your strategy and approach, somewhere in the ballpark of between 3 and 5% as an initial spending rate in retirement.
Gotcha. Okay. And I'm curious, do you have any books that you found to be particularly good in terms of retirement spending and retirement investing?
Book recommendations.
Yeah, I didn't warn you about this question.
Yeah. A book that's a little bit more technical, but is really good, is Michael Zwescher's Retirement Portfolios.
Okay. That's one I've not heard of.
I'm trying to write a book myself, but it's not ready yet, so I can't recommend that one.
When do you think it'll be ready?
I'm hoping by the end of the year.
Yeah. Okay. Well,
Harold Avensky and Dana Katz wrote. It's more like a textbook in that each chapter is by a different author, but it's called Retirement Income Redesigned. It's a really good book. It's not. It was published in 2006, so it's getting a little outdated, but it's a really good book too.
Great. Okay. Well, I'll put both of those in the show notes so people can check them out. Well, this has been very helpful. The one thing that I think can be frustrating for folks is that with all of this, it doesn't sound, and correct me if I'm wrong, there's no single one right answer. I mean, there are issues to consider. There are pros and cons with one approach versus another approach. And sometimes folks just want to hear the answer. And I'm not so sure that exists in the area of, retirement investing and retirement, spending. Right.
And this is an issue where sometimes people spend more time looking on how to save $20 when they buy the next vacuum cleaner than they do thinking about how they're going to approach a retirement income plan, how they should claim Social Security and everything else. And some of those decisions can add up to $100,000 or more over the lifetime. And so it's important to spend the time and really think through the issues and decide what's the best approach for you.
Yeah, the Social Security issue is immensely complicated. And when I get to that age, I'm simply going to hire someone to tell me what the best approach is, because there's just too many options and too many factors that are just hard for me to wrap my mind around on the Social Security front. Well, listen, I really appreciate your time. Is there anything I've missed? Any work you're doing now that you want to share with us in this area?
So this summer I'm trying to work on the book. I'm still trying to fill in a few holes. So I'm looking at reverse mortgages can potentially play an interesting role as part of an overall strategy. They can be abused in many ways, but there's been research that shows favorably how reverse mortgages could be used in retirement income and how to just use income annuities and whether to use an immediate annuity or a deferred income annuity and how that can fit into a retirement plan. There's just a lot of different ways to think about retirement income planning. And
will your book cover those issues?
Yes.
Good. Okay, well, we're looking forward to it.
Okay, great.
Are there reverse mortgages out there that don't kill you with fees?
I think there increasingly there are even some now that build the fees into the interest rate. And one of the really interesting ways to use the reverse mortgage is to just simply open the line of credit at age 62, and then you may never actually have to use it. So if it has a little bit higher interest rate, but you can get close to eliminating any sort of upfront fees, then yeah.
So they have reverse mortgages that act like a line of credit rather than giving you a lump sum and here it is. And
yeah, the government has increasingly made it more difficult to get lump sum amounts because that's how people were getting into the shady practices of taking out their home equity, putting it into some investment, and then losing everything. So the government's really been cracking down on that.
So you could open up a line of credit type reverse mortgage, and as you say, you may never need it or use it, but it's there if you have to.
And the one article I have finished and published so far was about really just as a way to protect the home value, especially when interest rates are low. This is something usually that's bad for most investments, but it's nice for opening a reverse mortgage when interest rates are low, because the initial line of credit will be higher. And then because it has a variable interest rate, the line of credit will grow throughout the retirement. If interest rates go up, it can really, if you end up living in your home long enough, at some point your line of credit could grow to be worth more than the value of your home. And it's a non-recourse loan. You can get a windfall and you can protect the value of your home that way, where you just then, if your line of credit is worth $400,000 and you think your home's worth $300,000, take out the $400,000 and you're done with it. And then,
okay, because I know obviously on an annuity, the low rates are going to hurt you. Yeah, but on a reverse mortgage, they help you.
Because they get you a higher initial line of credit.
Well, I will track down that article that you wrote. Is it on your website or is it in another publication?
It's from Advisor Perspectives. Okay. I'm sure I have a link to it from my website.
I'll track it down. Well, great. Well, this has been very helpful. I appreciate it. We look forward to your new book. And thank you for being on the show. Okay, thank you. It's a pleasure talking. Well, I hope you enjoyed the interview. Thanks so much to Dr. Pfau for spending the time with us today. I will, he mentioned a couple of books and a couple of other resources. I will have links to those in the show notes today. Again, DoughRoller.net/podcast187. So you can check out those links there. And if you have any questions, you can reach out to him directly at his website or shoot me an email, dr@DoughRoller.net, and I'll either answer the question or forward it to him. But again, a big thanks to him for taking the time to come out on to come on the show. Now, before we wrap up today, I mentioned a website that could help you if you're interested in maybe considering solar energy. Well, it's EnergySage.com, EnergySage.com, EnergySage.com. I read about this in a magazine. Actually, what I've started to do, and my wife and I did this the other day, we'll take one day a month. And we'll go to the library, and for a couple of hours, we'll just sit there and devour all of the magazines in the library. I mean, of course, I'm over there looking at money and investing, and she's looking at, her stuff, which I don't even know what she was looking at. But, we were all just, rather than spending a ton of money on subscriptions, we just spend a couple of hours each month. And, one thing I noticed, and I didn't even realize this until we started doing this, is that a lot of the Morningstar newsletters that you have to pay for, libraries have them. And I found a number of retirement newsletters that our library has as well that I'd never heard of. And so it was kind of eye-opening for me. But in any event, so in one of the magazines, and I don't even remember which one, it may have been Money, but in any event, they mentioned Energy Sage. And so I checked it out, and it's got a lot of resources. When you go to the website, you'll see at the top some links. One is to the solar marketplace. And if you click that link, you'll see a way to get an instant estimate. And it's pretty cool the way this tool works. You put in your address, and I started typing, it immediately filled it in, or pretty quickly, much like Google Maps does. And then it actually brought up Google Maps and showed, a satellite view of my home, which is a little freaky, but whatever. And then it made some projections. If I were to pay cash for a system, they estimate the cost would be $25,000. And my net savings after factoring in costs over 20 years would be $17,000. How long would it take me to earn back my cost? 13.3 years. And there's obviously a lot of assumptions in that. And so you need to look at that carefully. And, I certainly wouldn't make a decision based on this estimator, but it was kind of an interesting thing to look at. They also have a calculator if you were to finance the purchase of a solar system. I don't think we're going to go that way right now. I mean, part of the issue for us is that we there's a ton of trees around our home, and that actually would present somewhat of a problem for solar energy for us. Our roof, it gets some sunlight, but it gets a lot of shade too. So that would be an issue for us. But I thought, I wanted to pass this along. If you're considering solar power, check out EnergySage.com. And of course, if you have solar power, I'd love to hear from you. I mean, if you're interested in coming on the show and talking to, for an interview, with, how'd you make the decision? What did it cost? How'd the installation go? Are you saving money? Are you happy you did it? Whatever. I'd love to have you on the show. So again, shoot me an email, dr@doughroller.net. If that's too much, you just want to let me know, your experience with solar power, that'd be great too. Again, dr@doughroller.net. And if you'd like to support the show, you can, doughroller.net/support. A big thank you for those that are already supporting the show. Hey, hope you have a great day. And until next time, remember, and you know what it is, the best thing money can buy is financial freedom.